Great. All right. Good morning, good afternoon, depends on where you are connected. My name is Emmanuel Adigbola, and I'm so excited to welcome all of you to today's training. I'm so excited to also have our guest in the house. Today, we are going to be looking into how to start your own bank. I know many people are so skeptical about that topic. Really? Is it possible? How can you create your own bank? But before we get into that, let me allow our host to kind of introduce ourselves. Then we'll get to the party. Go ahead and introduce yourself to our viewers, Ms. Udoka.
Yes, hello everybody. I'm Udoka. I'm a life insurance broker, and I'm here to teach everybody how to actually be their own bank.
Awesome. How to actually be your own bank, because many people saw the title and it's like, okay, is it really? Oh, it's still good to be true. But I tell you what, if it is good to be true, then that is why you need to be on today's training. However, if you are connected with us, do me a favor, type in your name and your location where you are connected. Let's be able to recognize you and also welcome you. Then do me a favor, like this video, subscribe to this YouTube channel, and make sure you share this with somebody, because you don't know whom you might be helping along the line. So type in your name and your location where you are connected. So I'm going to just allow you to do your own thing. If possible, I'm just going to mute myself. But once in a while, I can just come in and possibly ask questions. I hope that is okay by you.
Yeah, that sounds good. That sounds great.
Awesome. So over to you. Go ahead.
Yes, so good morning, everybody. We're talking about how to be your own bank. Is my slideshow showing?
Yes, it's showing very, very well. It's showing clearly. Yeah.
Okay, perfect. So how to be your own bank. And first of all, I want to reintroduce myself. I'm Udoka Omenakor. I'm a life insurance broker. What that means is that I actually have access to a variety of different carriers, because when it comes to life insurance, it's not one size fits all. Different people have different needs. And I help educate families on what life insurance can do. It can create generational wealth. You can avoid probate and taxes. It can supplement your retirement. It can take care of long-term healthcare costs. It has things called living benefits. But today, I'm going to show you how people, especially the wealthy in the United States, are using life insurance to actually be their own bank. Let's talk about how a bank works, first of all.
Let me just quickly pump in. Your slide is not showing very well. Can you try to show the slide? Let me see. I'm watching also on the other screen. Okay, cool. It's showing now.
Okay.
Awesome.
Okay,
Awesome. Okay, cool. I have my pen. I'm taking note, and I hope you guys, you have your pen and you are taking note. And it doesn't matter where you are, either you are in Nigeria, you are in US, you are in London, you are in Australia. The concept is the same. You just need to possibly, maybe after the training, you're going to talk to Ms. Udoka or find somebody in your local area that will help you. But come on, let's get to the party. Let me keep my mouth shut.
All right, I love it. Yes, different countries have their own system, but generally it's the same concept. So how a bank works is that you put money into a bank. And if you've ever put your money in a bank, have you ever thought about, what is the bank doing with my money? Why does the bank have my money? If you've ever noticed on your bank statement, there's a line that says that you have interest earned. Most people ignore it because you're earning 0.01% interest, negligible. You're earning pennies, so people ignore it. But actually, the purpose of that is because the bank is using your money, leveraging your money, so that the bank can get more money. How does the bank leverage your money to get more money? They're using your money to give people loans. They're using your money to as collateral so they can get loans. When they give out loans to people, the interest they expect back when they give out those loans could be upwards of 7%. But they're only paying you less than 1%. So the bank makes their money on that spread. When the banks also use your money as collateral if they take out loans. A bank may take out a loan and use that money that they took out to make bigger investments. But they're only paying you, again, less than 1%. So the question is, how do you take advantage of the fact that people are making money on that spread? How do you make money on your money rather than allowing the bank to make money on you? So why life insurance? Why are people using life insurance to make this happen? It's because of tax law loopholes. Now, the tax laws, the section numbers and things like that will be different depending on the country that you're in. I included specifically the US IRS tax laws. And I'm not going to go too into the weeds, section 7702 and things like that, because people don't actually care about, nobody actually goes and looks up the IRS tax code to look up, okay, what does that section say? You just want to know, how is this possible? So I have references there. But the important thing to note is that this bank on yourself idea is really only possible using life insurance. You can't do this idea with different retirement products like an IRA or other types of financial products. It's really only life insurance that you can do this with. Now, people have been utilizing life insurance to take advantage of the money game for a very long time. The old way was this phrase called buy term invested difference. Meaning you would buy term life insurance, which is a type of life insurance that expires. And the extra money that you're saving from not buying a longer policy, you put that money into some type of other financial product. That's the old way. It's like having a record player and playing LPs and records and things like that. Then later on, they created a better way. They would use what's called a whole life policy to do this bank on yourself system. A whole life policy is a permanent life insurance policy. That means it lasts your entire life. By the way, if you don't really know what life insurance is a contract between you and a life insurance company. The life insurance company has a lot of money. I mean, billions and billions of dollars. You, as an individual person, you don't have that much money. Okay, you people are struggling to even get to the $1 million mark.
Okay, I'm going to cover it. You know, I already apologize in advance that I will be pumping in and out, right?
Oh yeah, no problem.
So many people have this kind of belief that when you're talking about life insurance, it's like, okay, you are planning to die or you are getting ready to die. So how do you want to explain that? Then when you talk about life insurance, I know you made mention of it, but many people might not really catch it because it's not just all the types of life insurance that you can actually use for this type of program that we are talking about. So
yeah,
having life insurance, does that mean that, okay, you are preparing your way to die or what? Can you just throw in a little into that?
Yes, let me explain that a little bit, because the biggest intent of life insurance is that when you pass away, money will be passed on to your family, not your government, not paying estate taxes, not paying creditors and people who claim that you owe them money, not paying anybody else but your family. And so people use life insurance because maybe in your lifetime you were only able to save $1 million, but you could have a life insurance policy for $10 million and pass that on to your family. Now, the big misconception people have is It's because they're thinking of the old way. They're thinking of this record player that I have here, where you really only benefit from life insurance. Well, actually, you personally don't benefit, your family benefits, your generations benefit. But life insurance today is able to help you benefit while you're living. Like I mentioned previously, I've mentioned it very briefly, but it could take care of your healthcare costs. It can take care of your retirement. It can take care of a lot of things while you're alive. But today I'm focusing on this bank on yourself method. And when they created this whole life policy that lasts your entire life, that's when people started to see life insurance as a way to have additional advantages while they're alive, not just for their family after they've passed. And that's where the bank on yourself method really started to happen. But today, that was like using a CD player, okay? And if you still are using a CD player and have your headphones, I mean, it's kind of like, why would you do that? The CD player skips if you're going on a jog, it's messing up. You don't even know where to buy CDs anymore. Today, we're using iPods, iPhones, streaming music on whatever device you have. And that is what the Index Universal Life policy is today. Many people don't know about it simply because back in the 70s and 80s, it was very popular for life insurance agents to go knock, 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 knock on your door. Hey, let me tell you about life insurance. And the only thing available was the term or the whole life. And that's really all people knew. Today, your grandparents or your parents knew that. And so where do you learn most of your financial information? You learn it from your parents and your grandparents. You learn it from your family. So most people's financial knowledge only goes as far as the people who brought them up, where their knowledge went to. But today,
repeat that statement. Repeat that statement.
Yeah.
Or your teacher. Like talking about where you get your financial education from. Most of us is from our parent or grandparent, or most of us from our teachers back maybe elementary or high school. And these people, they have wrong programming. So please repeat that sentence. I'm taking notes.
Yes, most people's financial information can only go as far as the people who raised them, the teachers who raised them, the parents who raised them, the family members who raised them. And unfortunately, if your goal is to be financially independent, wealthy, to do better than the people that raised you, you're not going to be able to do that using their information. So it's great that you're all on this call right now and you're learning about this product, Index Universal Life. It is like a supercharged bank on yourself. So let me explain how it works. I have an example here. Let's say you opened up an IUL product and you managed to save $1 million in your IUL. Let's say you want to do some real estate. You want to use that $1 million so you can buy real estate. You heard this. Right now it's a seller's market. You can make a great ROI and you want to take some money out to take advantage of that. How it works is you will actually borrow your own money.
Right.
You'll fill out a form and say, I have $1 million that I put into my IUL. I want to borrow this money. The life insurance company will send you that money within 48 hours. But your $1 million is still in your policy. You're borrowing money from the insurance carrier. They're using your $1 million that's literally in your policy as collateral for the loan they just gave you. Now, why does this work? First of all, it needs to be a loan because that IRS tax code thing that I showed you earlier, that's how it works. If it's a loan, the government cannot ask you to pay taxes on a loan. The other thing is your money is growing with interest. So The way interest works back here with the CD player, with the whole life, you would request a loan. The insurance company will say that we'll give you this loan at a rate of 2%, but they will also make sure that your money in your account is credited 2%. So you essentially paid $0. But the reason why IUL is like this on Supercharge is because the IUL is doing something called indexing. Let me show you how indexing works. There's 3 different ways that money can grow. There's the fixed rate, which is the blue line. There's the variable rate, which is the red line. And then there's index, which is the green line. Now, most people, their money is in the bank, which is giving them a fixed rate of return. 0.01%. Maybe you have a CD or whatever term your country uses for a guaranteed rate of return, and it's usually low. It's usually 1%, 2%, 3%. That's what this blue line is doing here. It grows very, very steadily. The disadvantage of that is that if the market goes way up, you don't get to participate in those gains. The advantage to this fixed line is that you always know, no matter what, even if the market crashes, at least I'm going to get my 3%. And the biggest issue with this is that inflation is usually 3 to 4%, meaning this money over time is actually losing value. Then we have this variable line, this red line, which is when we talk about the stock market or investing, we're usually talking about this red line. Anything that you're investing your money in is in this red line. Even if you're doing real estate, the real estate market behaves like this red line. There's ups and then there's downs. There's times where everybody's winning and there are times where everybody's losing. The benefit of this is that over time, the market tends to trend upward over time. Since we've been tracking the economy, that's what it's been doing. So you're banking on that idea that the market is going to trend upward. If I have my money in here long enough, I will make money. The other benefit is if you're savvy with your investment, you know what you're doing, you have a pulse on what the market's doing, you can take advantage of these big spikes and take home a lot of money and do things with that. The disadvantage to variable is that when the market goes down, you lose money. So every smart investor knows that, hey, I got to make sure I'm diversified because at any given moment, one of my investments could go under. And if all my money is there, I'm at a loss. Now, this green line, it mixes the best of both of these worlds. When the red line, when the variable, when the market is going up, you are also going up. The thing about this green line is that there is a cap on how much you can go up. So if the market is going up very quickly, you're not going to make as much as the savvy investor in the red line, but you're going to make a lot more than the person in this blue line. Here's where the real benefit comes in. When the market goes down, you don't lose anything. You are stayed at a fixed rate. Some insurance carriers say it's just zero. If the market goes down, you don't lose anything. Some carriers have a guarantee, will give you 1%, 2%. But this is the benefit of indexing, is you can take advantage of some of the capital gains, some of the growth in the economy without having to risk losing anything. Meaning our friend here who has been saving money in his IUL, part of this $1 million is the growth that his money earned. You don't pay taxes on growth your money earns in your life insurance policy. As long as you maintain your policy, meaning you don't cancel it, you don't pay any taxes on the growth your money earned. So let's dive deeper into what the situation is with an IUL. You have
so can I just jump in also? So quick question. So
Sure.
like, is there like a limit to what you can have in that account, that you can contribute to that account in a year?
Very good question. The limit depends on the person. So it depending on your financial situation, we set it up in a way that makes sense for your current financial situation. And we have to set it up in a way that if you feel like, hey, eventually in 3 years, I'm only putting $300 a month right now, but in a year or two, I want to put 1,000 a month. We have to set things up in such a way that it will allow you to do that. This thing is so powerful that the government does put a cap. They do say, hey, depending on this person's financial situation when they started it, there's a limit to what will allow. So that's why it's very important. It's not a one size fits all. You have to sit down with an agent or a broker so they can figure out what's the best thing for you, because there is a limit. It's like there's a minimum and there's a limit. So
Yeah.
the higher your minimum.
Like yesterday, the program we had yesterday, we talked about 4 steps to, stop living paycheck to paycheck. And one of the steps talks about assessing it. So this is what will help you to be able to assess yourself. You want to look at, okay, where are you? Many of you connected right now, if I ask you what is your net worth, most of you don't even know what that means. So all this helps you to be able to, put yourself together and be able to say, okay, you know what, okay, this is growing. And like about 8-9 years ago, when I got introduced to this concept, Udoka, man, I was like, what, really? Back of, I actually paid to attend a training that we are doing free of charge like this.
Oh, wow.
Yes, how to operate Bank of You Inc. That was the title. And when they broke it down, I say, really, this is what the rich does. They pass on wealth to their children, to their grandchildren, and they themselves, they can pump in money to their IUL, and they can borrow money out of it. Do you know, the last time I borrowed money from my account, guess the interest rate I paid on it, 1.5%. And that 1.5 also goes back to my account. Well, anyway, just to throw that in so that our audience will know that this is not just theory. By His grace, I have 6 policies under this concept for my family. Right on.
That's amazing. That's awesome. Yeah. So there's different way. The more money you have available that you're able to make, the more you can take advantage of this. I have a client who there's so many different tricks. I don't want to start confusing people, but there's a way that you can have your actual bank actually contribute into this for you. It's so amazing what you can do with this.
Wow.
But for the average person listening to this, I'm going to speak on what you can actually do now. And I'm using $1 million as an example because it's just the easiest number to use. So let's take a deeper dive into what our friend is doing with his money. He has $1 million sitting in his IUL, and it's already earning money. That money is earning money. He fills out a form so he can borrow $1 million. When you get this form, it will say, do you want to withdraw your money, or do you want to take out a loan using your money as collateral? Big mistake. People who don't have somebody guiding them, they will withdraw their money. Mistake. Now you have to pay taxes. Now that money is no longer in your IUL, so it's no longer growing. That's a mistake. You want to borrow the money because that money will remain in your IUL and will continue growing interest while you're using the money to do something else. So let's say the bank gives him a loan rate, the carrier, the insurance carrier has a loan rate of 2%. You are guaranteed to earn 2% by the carrier, credited back to you. But if the market goes higher, you will be allowed to keep those gains. So let's say you had a loan rate of 2%. that's $20,000. And your $1 million earned 10%, that's $100,000. You made an extra $80,000. While you're using $1 million to do real estate deals and make money there, your IUL helped you make more money.
All right.
This is how people are becoming a bank, because this is exactly how banks work. One more thing I want to mention about the IUL as well. The IULs have what's called income for life. What that means is it is literally what it sounds like. You have income for life, meaning the insurance company is able to guarantee you a certain paycheck every year for the rest of your life. If you have enough money saved in your IUL, you can activate this before retirement age. Most people, they'll use this feature when they're in their 60s and have a residual stream of income that they can never outlive. So that's another way people are using this as like a supercharged bank. So I covered a lot, especially if this is a new concept for people. What questions do you see anybody has, or what questions do you think somebody might have?
Yes, I just want to quickly also throw in something into what you said about income for life. But guys, if you have any question, I know this concept might even be mesmerizing some of you. You might be finding it difficult to grasp it. But if you have any question, go ahead and make sure you type in your question on the chat window. I believe most of you are connected on YouTube. So make sure you type in your question. And of course, Ms. Udoka is going to be giving us information whereby some of you that are in United States might also want to connect with her. And I mean, by His grace, I pastor a church. I'm bringing Udoka even to our church to come and educate some of the adults, because many people don't understand this concept, So like what I understand a little bit about the income for life, let me try, because sometimes when I talk, I try to talk to layman. I might not be using some jargons and terminology like what Udoka will use. If you have a life insurance like IUL, for example, some call it universal life insurance, right? It's still almost the same thing, right?
Mm-hmm.
Now, God forbid, let's say, okay, you die, okay, before certain age, your beneficiary definitely, enjoys what you have because you have that. But now, if you are alive to a certain age, and you might set up, when you are setting up your account, when you are setting up this policy, you might put it, okay, 10 years, maybe 20, it depends on where you are. Because if you are 50 years old now, you might just want to set it up for like 15 years. If you are 60 years old, you might just want to set it up for just like what you will put in will be different to each other. Somebody that is 20 years old, if he's starting this, you can even be putting it like $20, $50 every month because you are starting so early. But if somebody is like a 55, 60 and you are starting, maybe yours might be going to almost $1,000, $2,000 every month. Depends on, yesterday we also did something how to calculate how much you need to retire. You see, this week we've been talking about different investing. That okay, how much do you need to retire? You have to look at your expenses right now, then multiply it by 200. So when you multiply that by 200, then how much do you need to be making every month? You multiply that amount by 0.6. That is averagely, you are thinking, okay, your investment will give you 6% annual. Then divided by 12, that's what you're going to be having every month. Now, with this kind of program that Ms. Udoka is talking to us about, if you get to a certain age, for instance, the one I set up, by God's grace, at age 67 to 100, I have specific amount I'm going to be collecting every year. You see what I'm saying? So, and God forbid I will not die young before my time. There is what my family also will enjoy. So that is what we are talking about. So go ahead and just maybe correct me, throw more light to what I just said.
Yeah, it's so powerful what Emmanuel is saying, that because the money that you're putting into your policy grows, you have to also remember that it is life insurance. So there is a cost to having life insurance. But if you're putting in enough money, because your money is growing, if you put in enough money, it can be to the point where you never have to spend money. You never have to put money into your policy again. The policy can pay for itself. So I have a client actually that set up her IUL for her child. Her child is 4 years old. She's going to put $1,000 a month until the child is 16 years old. From then on, she won't put a single dollar again, unless the child wants to add more. But she set it up in such a way that if the child wanted to, the child can have this income for life at age 40, 47. Wow. The child could have an early retirement simply because she set up something for her child early. She's going to put in a lot of money up front, and the money will just continue to grow for as long as the child allows it to grow. So it's very powerful. Since it is still life insurance, let's say you're 80 something years old, you're enjoying your income for life from your policy, and you were to pass away, not only the money that's left will be given to your family, but also the actual death benefit will be given to your family. So you're able to enjoy your money, but still make sure you're leaving money for your family and creating a legacy. So it's very, very powerful. I'm going to put two details here. I'm clicking the wrong way. Yeah. So first of all, like I mentioned, this plan is highly individualized. Here's my information. Let me also show you some resources where if you want to learn more details, you want to see more examples, you feel like I'm not really ready to talk to Udoka, or I'm in a different country, you can check out Doug Andrews on YouTube. Doug Andrews, he's a fantastic educator about Bank on Yourself. He is somebody he's been doing life insurance and other investment products for many, many years. He was doing Bank on Yourself when it was first kind of invented, and he's been keeping up with the times. And when he learned about the IUL, when it was created, it just blew his mind. So he has a lot of videos on YouTube that explains it in more detail. We also have this book you can order called Tax-Free Retirement by Patrick Kelly. Learning how do you have the retirement where you're not having to pay taxes on that money. We also have Living a Life of Significance by Robert Ben Mosh, and he talks about what else the IUL can do, rather more than just, the income for life, the Bank on Yourself, but also it allows you to take care of healthcare costs. So you can make sure that as you're aging, you are still living your life with dignity. Not the way that most people have to do, where you're hoping the community takes care of you, you're hoping your children take care of you. Healthcare costs go up, nursing facilities, home healthcare, those costs are very expensive. And this Living a Life of Significance teaches you how to ensure that your old age will be filled with dignity so you can continue giving significance. But here again, it's my information. You can text me at this number, you can email me, and then I'll make sure myself or somebody on my team reaches out to you so we can give you a detailed plan of how you can take advantage of this.
Wow. Thank you so much, Doka. You can stop sharing. I have one or two questions. Someone says, I think Prince says, do the insurance companies in Nigeria offer this type of policy? Do you know whether the insurance companies in Nigeria offer this type of a policy?
I'm not sure, but I can do research on that. And if he reaches out to me, if he sends me an email, I'll be able to email him back with the information I gather.
Oh, okay, cool. So thank you so much. I mean, we don't have to prolong this. There are other questions. It's also Nigeria related. So you guys, you've already had Ms. Udoka's contact, and just reach out to her. But let me warn you, when you send message to Udoka, make sure you have grace for patience to wait for your reply. But she's going to get in touch with you anyway. Thank you so much. I'm going to check with you with your calendar. We having a program in church in the month of August, and I'll look into bringing you in also to come and educate our adults, at least, especially even the young adults, the working class adults. It doesn't matter where each and every one of us are in our life, we can tap into this. Many people don't know this. You might have been in America for 40 years, 50 years. If you don't know, you don't know. So it's just all information. Information is key. And we're in information age, and that is exactly what we are doing. Thank you so much once again. We really appreciate you. We got to get back to business. Today is a very big news day on Forex World. Thank you, guys, and we see you guys later.